So welcome to this video. In this video we are going to discuss about overtrading. So overtrading refers to the state when a business is carrying out transactions at a high speed which cannot be supported by its working capital. This means that the increased number of transactions are putting pressure on the cash flow of the business, thus giving rise to risks of insolvency. So what is this problem of overtrading here? See, overtrading is a situation where a company has less cash in its hands. Okay, it has less cash in hands, but it does more business. Okay, so is it wrong? The answer is yes, it is wrong, because the company should not keep on doing more business with less amount of cash in hand. Okay, the why is the reason, why can we say it like that? Okay, why is overtrading a bad thing? For example, assume that we buy goods. Okay, we buy raw materials on cash. Okay, so we buy raw materials on cash and then we convert it. Okay, so for converting we have to pay, right? We have to pay for conversion. We have to pay expenses such as wages, for electricity, and for rent. Okay, we have to pay, and usually these are expenses which are paid in cash. So once a good has been converted from raw material to a finished stock, okay, this finished stock will be stored and it will be sold. Okay, so sales will also be on credit. Okay, sales can be on credit. So what happens here is, assume that you have bought raw materials for some 50 rupees and you have spent some 30 rupees on all this kind of items, and sales is 100. Okay, see, this is cash which is going out of your business. This is also goes out of your business, but the money that comes to you is in terms of credit. Okay, and if this credit is going to be on 2 months, then how can you run your business for that 2 months? Okay, how can you run your business on those 2 months? So that becomes a huge problem here. So you can do it for a shorter period of time. For example, you can get some kind of short-term loans, right? You can get, to avoid this problem, you can avoid by raising short-term loan, or you can get an overdraft, right? So you sell goods on credit, right? Thereafter you go and raise a short-term loan, and this short-term loan is on credit, sorry, cash. You get that cash. So if you're going to do this just for the same amount for again for another few set of cycles, it's not a problem. But when you're trying to increase these amounts, okay, when you're going to try to increase these amounts, okay, for example, you got an OD for this kind of a setup. Okay, and the OD is for how much? You have got for 80 rupees you have got, because with this 80 as cash, with this cash only, again till the credit sales money comes in, okay, still the credit sales money comes in, you have to use this cash, this 8 rupees cash, to buy raw materials and to buy for converting expenses. Okay, so you can use this 80. So after 2 months of credit, so this loan will be there for 2 months. Thereafter this cash should come in, this 100 would come in. Once it comes in, again we can solve it. But business is not like that. Business is not like one transactions here, it's like multiple transactions. Okay, so you can't just make 100 rupees sale and you can just wait for it. Okay, you have to keep on making more and more sales. Okay, so more and more sales, what happens is, when we want to sell another 100 rupees of goods, okay, we have to get something like 100 rupees of raw materials. We have to buy okay, so this will be again 60, and we can sell this on 200. Okay, but now if you look at here, how much of loan should we get? Okay, we have to get a loan for 160, not for 80, because we are additionally expanding our business, so we have to get it for 160. So how long can you keep on doing this? See, you have to keep on doing this as long as you want to expand. Okay, you can expand, but assume that the maximum OD limit, okay, there's a limit which is set by the bank. That's a limit of something, we'll say 200. So it is already at 200. Okay, so if you again want to increase your business 3 times now, okay, So this would become okay. So this will become 150. This will become 90. So this will become 300. Okay. But can they get the credit? Because if they want to get a credit, they have to get a credit for 240. Okay. The limit itself is only 200. So the OD, the bank will not give you overdraft. So now what is going to be the problem? The problem is you can't get the finance. You can't get this finance. Okay. Either your operations has to be limited. Okay. It has to be limited at 100 rupees of 100 rupees of raw material and 200 rupees of sales. You have to limit that. Or if you want to expand, okay, if you want to expand, you have to get additional funding. Okay. So how will you get additional funding? So there are like several ways that you can do it. So what you can do is you can get credit. Okay. Rather than paying all this on cash, you can get this on credit. Okay. Buying the goods on credit. Okay. You can buy goods on credit. So what would happen is you will get trade payables. You will get outstanding wages, rent. Okay, by all these things you can increase. So what happens is rather than paying these on cash, you can buy them on credit. But there is also a limit to that, right? You can't like keep on asking your suppliers for credit, and your employees will not work on credit, right? There's a limit to it. So when those limits are hitting up, okay, okay, at that point of time you have to halt your entire operations. Okay, there's a limit of, for example, trade payables limit might be like 200. Okay, and this is like 100 we'll put. Okay, so maximum that the credit that we can get from outside people is for 500. Okay, beyond if it goes it's like impossible. So if you see, it's already like 240 here. Okay, it's already 240 of amount of credit which is there. So we can't say 240. Yes, approximately. So you can say that there's a maximum limit of 500 only. So you can increase your expansion by this amount. Okay, but there is a limit again here. Once this limit has been touched, you can't go for further borrowing. Okay, if you try to go for further borrowing, your raw material supply will not give you the materials, your employees will not work for you, your landowner will ask you to make the payment or get out of the building. Okay, and you have to employ more people to chase your customers to get the amount from them. Okay, so all these things will become a headache now. So these are a headache. So to avoid these headache, okay, the only way is not to raise short term loans. Okay, it's to raise long term loans. Okay, or equity finance. So you get either a long term loan or either a equity capital. So that's how it has to be avoided. Okay, so which are the companies which face this kinds of a problem? See, overtrading problem is like faced by startups, SMEs, rapidly expanding businesses. Okay, all these companies will face a overtrading situation at one point of time, because when their sales are like catching up and they are like growing, that is the point at which these companies will get into the problem of overtrading. So can we find out overtrading situation before it appears? Okay, or as it appears, can we like try to find out? So there are like financial indicators which indicate the overtrading problem. So the first one is rapid increase in sales. So like what we saw, the sales would be like rapidly increasing here. Two, gradual increase in current assets. Why is that? Because the company is like storing more goods, right? They are buying more raw materials. That is a current asset, and they also have a lot of finished goods. So again, that is a current asset. They sell a lot of goods on credit, so that becomes a receivable. So all these are current asset. So what is the rapid increase in current liabilities? So you can see a difference between here. Current asset is gradually increasing, but current liabilities is rapidly increasing. Why is it so? See, current liabilities refers to the overdraft. Okay, so if you see here, the overdraft amount, okay, the overdraft amount is equivalent to the sales amount. Okay, it's somewhat like equal to the sales amount or equivalent to the raw materials and conversion amount. It depends upon the company how they want it. So if you see here, the current liabilities would quickly go up. Okay, it will quickly go up because we will start at one point of time, we'll start to have like more overdraft, more trade payables, more outstanding expenses and rent. Okay, because of all these three things, our current liabilities would go up. Increased reliance on overdraft, of course, yes, that's overdraft is our first measure. We try to expand our sales, so overdraft will actually increase and the reliance on it would be like much more higher. Decline in current and quick ratios. So current and quick ratios will start to decline. Okay, why is it that so? Because if you see, current asset goes up slowly, but current liabilities goes up very quickly. Okay, as a numerator, current liabilities goes up very quickly. Both these ratios will start to fall. So the ratio of sales income divided by net working capital will start to rise. Okay, so when we do a formula or when we do an answer, we'll explain that. There will be an increase in sales, inventory, debtors, creditors, and overdraft. Okay, because the company is trying to expand, so all these things will also expand. So how do we calculate the year-on-year increase? It's very simple. For example, if we try to find out year-on-year sales increase, it would be current sales divided by last year sales into 100. Okay, so that's about the financial indicators. So let's see about overcoming overtrading. Okay, how to overcome this overtrading problem. See, the best way to overcome this overtrading problem is to raise a long-term capital. It can be either a debt finance or an equity finance, and the company should temporarily halt its expansion. Okay, at some point of time, if the situation is very bad, it has to stop its sales, stabilize its business, collect the cash flows. Okay, collect the credit sales amount. Okay, increasing collection of receivables. The company should start reducing its inventory. That is, like the company has to once it has corrected the receivables, it has to again start selling, but as much as possible they have to start selling on cash, creating credit control, shortening the manufacturing cycle, and cutting costs and improving the efficiency. Okay, so these are the various ways in which a company can reduce the overtrading situation. So let's look at a problem here so that we'll get a better idea. Okay, this is a company that we have been like discussing, Whirlpool of India. So this company's P&L and balance sheet numbers we have. So we'll go to the workings that we require. Okay, it also has cash flows. So these are the workings that we require. So we have to first find out rapid increase in sales. Is it there or not? Okay. Okay, so we have to find out whether there's rapid increase in sales or not, like that. So what we'll do, we'll have 2 years. Okay, it's 2019 and 20. So just 1 second. Okay, so first we'll get the sales amount of 2019-20. So we'll get the current asset amount for 19 and 20. So here they are. We'll get the current liabilities amount. Okay, we need to get the overdraft amount. So let's see whether overdraft amount is there. Payables is there. Advance from customers is there. Other liability items is there. I think we'll take other liabilities items as overdraft. Okay, decline in current ratio. Okay, so first we have to compute current ratio. So for computing current ratio, we'll take current asset divided by current liabilities. Okay, so we have done that. we have to find out quick ratio. So quick ratio is little bit difficult. So what we'll do is we'll take the total current asset, okay, or else we'll take the total current assets minus the stock. So inventory is here. So inventory you will direct it and divided by the current liabilities. The same we can do it for the next year. Sales by net working capital. So sales we already have divided by working capital. Working capital is current asset minus current liabilities. We got the answer. Let's see for increase year on year, increase in sales, inventory, debtors, and this amount. Okay, so I think this we have already done. It's already there. We have to get inventory, debtors, and creditors amount. So let's get inventory amount.